Hey all, welcome to ShareTreck. This video is going to talk about Beam Therapeutics Q2 22 earnings. I'm going to put out my case for what could be the EPS for Beam Therapeutics, and I'm also going to share with you some information about what other analysts think about the EPS as well as revenue and profitability of the company, share price, etc. All the key parameters. So let's get started. Well, I'd like to get started by laying the background for it, and then we'll go on to my spreadsheet. And I'll walk you through my spreadsheet for earning estimates and everything. And then we'll go on to have a look at what other analysts are thinking. At that time, I'll take you to certain websites, which you can also check on your own. So that's the overall scheme of this video. Let me start off by first saying that Beam Therapeutics has got quite a few things going in its favor at this point of time. And one of the main things that I would look at is the fact that it has a strong balance sheet. They have $1.2 billion in their balance sheet at the end of Q1 2022. So that's a really strong balance sheet to have. This includes upfront payment of $300 million from Pfizer. Along with that, they also have great partnerships. Pfizer has a 4-year partnership that is worth potentially another $1.05 billion over and above the $300 million that's already been paid upfront. And this will be accrued over the next 4 years on meeting milestones and agreements. So overall, I think there is sound financial backing for Beam. Also, they've got their CRISPR IP from Harvard, which is positive at this point of time. That said, base editing technology seems to be much safer than CRISPR-Cas9. Base editing is a controlled use of CRISPR-Cas9. With an aim of avoiding double-strand breaks, because double-strand breaks is where we have problem with CRISPR-Cas9. The broken strands do create some problems, and they have been attributed to be carcinogenic in 9% to 10% of the instances. The study is still on, so we can't say conclusively anything about it. And as an investor, I don't claim to know much about genetics or biology. So I would refrain from making any conclusions, but there are definitely those voices out there that are cautioning about the use of CRISPR-Cas9. And some of these things will definitely surface during the FDA clinical trials, because that's where we'll have hard evidence based on actual trials which are monitored according to FDA standards. And that's when we can clearly say whether CRISPR-Cas9 is safe or not. But at this point of time, it seems to me that with base editing, just modifying the alphabets in the genome, I think it's much more safer because there is no double-strand breaks. With that said, the other thing I'm looking at is that potentially there could be a $25 million payment to come to Beam Therapeutics from Apellis Pharma due to their collaboration. And that payment is due in July 2022. I suspect Apellis would not pay $25 million to Beam before July 2022. So we'll consider that to be a Q3 revenue, so I will not include it here. That said, we assume $18.75 million for Q2, prorating from the total revenue of $300 million to be recognized over 4 years from the Pfizer deal. And revenue estimate here is very, very tricky. So let's go to my spreadsheet now. So here we are in my spreadsheet. I hope you are able to see my cursor. I'm going to walk you through this spreadsheet. First of all, let me talk about my assumptions. I'm going to assume that there's a high cash burn because the company is trying to get multiple pipeline items in the FDA approval process to progress further. So I have boosted the operating expenses. Another reason I have boosted the operating expenses also because of the inflation that we are facing overall and the tight labor market. All of those things are going to increase the cash burn. Unusual expenses have been reduced to conserve cash, and net operating interest income and other income increased marginally as interest rates hike. And a basic average shares I have boosted in line with the past average. So I have a factor of 1,000 between the last quarter and this quarter. So if you look at the basic average, diluted average share, we have moved from 68,704 to 69,704. And then we have our net interest income boosted to account for increased interest rates. So we have our net interest income out here. I have marginally boosted it to account for the increased interest rate. So these are all assumptions. And I'm going to show you the market beat also later on. That will give you an idea of why it is difficult to estimate the revenues here. And you can see that the revenues in the quarters have all been all over the place, like 763 to 51 to 84 to right now I'm projecting 18,750. That's around 18.75 million. If you look at the operating expenses, I have boosted the operating expenses because I am expecting that due to the increased interest rates and increased inflation, there's going to be a increase in operating expense. Plus, they have multiple pipeline items in FDA clinical trials very close to approval. So that's going to be an extra bit of cash burn. That gives us a operating income of negative 91,250. This has gone up from the previous quarter, and all the gray shaded cells out here are calculated cells. So I just have to put in the revenue and the expenses and the diluted shares. Everything else more or less gets calculated. I boosted the net non-operating interest income expense to 1,000. So there's the interest income because the interest rates have gone up. It's gone up. Other income expenses around 7,000. These are two numbers that I have positioned there. I don't think have been unreasonable. It's more or less close to what it was in the previous quarter. And that gives us a pre-tax income of 83,250, which has been arrived by adding the income to the loss that we have here from as operating income. And that's what gives us 83,250 negative as our pre-tax income, which is also the diluted net income available to common stockholders. We have got 69,704 stockholders. So if you divide the diluted net income by the average shares, we get 1.19 negative as our basic EPS. We'll compare this with what the other analysts have assumed, and we'll see where we stand at, just to do a sanity check on that. And if we go on to look at total operating income as reported, it's the same as the operating income that we had above. So no surprises out there. Total expenses come to 110. It's the same as the operating expenses. So we have more or less normalized income of 90,250, which is arrived at by adding the net operating income along with the net operating interest income expense. So that's what gives us 9250. And then we go on to look at the EBIT, which is the same as operating income, which is 91,250. And then we have net income from continuing operations coming at 83,250, which is the same as the net income that we saw earlier. There is no special adjustments out here in this case. And normalized EBITDA comes to 94,750. So that's what we have overall from my spreadsheet. So the basic data points that we're going to look at here is the diluted EPS or basic EPS, and we are going to look at the revenue number and see how it fares along when compared to other analysts. So let me take you to the other website. Let us start by first looking at Yahoo. When you look at Yahoo, you can see that they have had 11 analysts giving them estimates. And when it comes to earning estimate, the average earning estimate for the current quarter is going to be minus 1.08. The low estimate comes at minus 1.29, and the high estimate comes at minus 0.85. We have landed at minus 1.19, and that seems to be much closer to the low estimate, which is minus 1.28. I mean, low estimate in this case because we are talking about losses per share. Low means it's the worst case scenario. We are closer to the worst case scenario than to the average. So in this case, I think my estimates have been more aggressive than it usually is, aggressively conservative. With that said, let us look at the revenue estimate. There have been multiple analysts who did revenue estimates. For the current quarter, they are looking at average revenue of 8.39 million, high estimate of 25 million, and low estimate of 10K. I have assumed 18 million. That's what I have taken there as the most plausible amount. We'll find out what happens when we get the results. You should check out MarketBeat. It's a great website, and they have a lot of information available which helps you to do sanity check for your own estimates and also get new ideas from here. I'm not sponsored by MarketBeat, but I like this website. That's why I'm mentioning that. You can check it out at your own time. Okay, let us look at analyst ratings at marketbeat.com. And you can see that they are expecting a consensus share price of 106.29, with Wedbush coming in at 100, BMO Capital at 61, and Credit Suisse at 62. On the higher end of the estimate, we have Bank of America at 160, but their estimate was provided in the last quarter of 2021. So this is where you can see them all. So Wedbush around 100, BMO Capital 61, Credit Suisse 62, and then the highest out here is 150, which goes to Bank of America, and Guggenheim Partners have come in at 130. But Guggenheim is again in 2022. We can consider that, but I would let go of the Bank of America estimate because it is in the last quarter of 2021. It's obsolete since then. There has been a lot of developments and changes, so I would let that go. So that's what gives us an average price target of 106. Right now, I think we are at around $60. There's plenty of upside remaining out here. Revenue estimates. Let me go and take you to revenue estimates out here. So when we look at earnings estimates, we arrive at around August Q2. For Q2, we have an EPS of minus 1.06. which is a consensus estimate out here, average estimate. And if we were to look at the number of estimates provided for Q2 2022, there were 4 analysts who provided estimates. The high estimate is 0.92, average estimate is 1.06, and the low estimate is 1.28, which is the worst case scenario. We are at minus 1.19, which is closer to minus 1.28. So that's where we stand. Out here also, we are looking a bit aggressive. And if you go to look at the revenue estimate, now this is where you'll see the problem when it comes to estimating the revenue for Beam Therapeutics. You can see here in Q4 2021, analysts estimated a revenue of 9.58 million, whereas Beam came in with a revenue of 51.07. Whereas in Q1 2022, analysts estimated 44.15 million, but Beam came in with 8.40 million. So as you can see, it's very tricky out here, and the same is reflected in the past also when there have been estimates made. So I have tried to do whatever is logical in my mind to come up with a revenue, and that has got a lot of bearings on what is going to be happening with EPS. So I'm not very confident about this estimate, but the sanity check with other analysts seems to put me in a decent ballpark. I'm not way off the mark. So I'll go with this, and we'll see what happens. So that brings me to the end of the analysis, but I want to dwell a little bit on the bad news that Beam had. Their CAR-T therapy got put on hold by FDA. But I'm thinking that this company has got significant cash resources at hand. It has got great partnerships that it has tied up with, which are expected to provide a lot of revenue going forward. And for next quarter also, we have revenue assured from Apellis. So given the fact that there is no pressure on the revenue side, and also the historical fact that many times FDA puts approvals on hold or puts clinical trials on hold in anticipation for more information that they need to clarify their concerns. And with the cash resources available with Beam can definitely go ahead and meet those requirements. So I'm more or less expecting that in the next 3 to 6 months, this hold will be lifted, and that will be a further catalyst for Beam going forward. CAR-T therapies have been approved many times before by FDA, and they're already in the market, and they cost around 450,000 a pop. That's the average that I have seen out there in terms of price range. So Beam should not have too much of a problem. The only wild card out here is that all the CAR-T therapies so far have been based on CD19 and BCMA, whereas I think Beam has got CD7 as the target. So that's the only difference out there. But CAR-T therapies have definitely succeeded, regardless of the concerns that have been put out about cytokinesis. But overall, I think everything is looking good for Beam, in my opinion. So I wouldn't worry that much. I think Beam is one of the stronger companies, and their base editing technology is less risky as compared to CRISPR-Cas9, at least at this point of time, until it is formally disproven that double-strand breaks are something to worry about. So with that said, I'd like to bring this video to an end. I hope you liked the video. If you did, please press a like out there so that the YouTube community can discover our channel. And also, if you haven't subscribed, why not? Please subscribe and help us grow this community. We have crossed 600 and our next target is 1,000. And I'd really appreciate your support towards it. Thanks and have a great day. Bye for now.